We're picking up here with Section 179 deductions, and I know I've made reference to that in earlier videos, but your book kind of jumps around a little bit, so I didn't spend a lot of time on it, but we will dig into it now. 179 deduction allows certain taxpayers to be able to expense 100% of the cost of the non-real estate assets that they've purchased and put into service in a particular year. Now, this is a huge benefit to a small business owner that might go out and spend a ton of money on a piece of equipment, and the idea that he would have to expense that out over the asset's useful life could be a real financial hardship for them because they had to lay out the cash up front. So the 179 allows them, with some limitations, to take all of that up front. So the maximum amount annually is $1,020,000. There is a phase out. If you acquire more property, more than $2,550,000, they start to chip away at the $1,020,000. Furthermore, you cannot use Section 179 deductions to generate a loss. So you are limited to the taxpayer's taxable income. You could zero out your taxable income by using Section 179, but you can't use it to trigger a loss. And so we will apply, if we elect to use 179, we apply that first. Anything extra, and we'll see an example shortly, goes to bonus depreciation. And quite often there's really nothing left to even go to maker's depreciation because right now there's 100% bonus depreciation. So we're probably not going to have anything left to treat under makers. Here's our example. On May 2nd, 2019, Nano Paint Inc. purchased equipment for use in his business. It is the company's only purchase of business property in 2019. It cost $1,500,000. It's 7-year maker's property. Nano Paint's business income before any cost recovery is $1,075,000. They want to expense this immediately. And they've elected out of the bonus depreciation. So what can they do? Well, it is not above the $2,500,000 and change limit. So we're not going to be limited in that respect. However, it is more than the $1,020,000. But it's also more than they earned in the year. So how's this going to shake out? Hopefully you're saying to yourself right about now. So we got a couple of things going on here. What we know is they spent more than they're allowed to take for 179 deduction entirely, and that what they spent was also more than their taxable income. So what are they going to do? They first need to separate out what is allowable under 179. So we're going to carve that out and set it aside a second. Of the $1,500,000 they spent, $1,020,000 of it is subject to Section 179. So they've got this $480,000 left over. We're going to look to the makers tables to figure out what we can take for depreciation there. We've got $68,592. Now, when we apply the $68,592 to their taxable income of, I believe it was 1,075, or excuse me, 1,075,000, that maker's depreciation reduces their taxable income down to $1,006,408. Now remember, we can't use now the Section 179 deduction to throw them into loss territory. All we can do is zero out their taxable income with the 179 deduction. And so we're going to take $1,006,408 in 179 deduction, even though there was potentially available the 1,020,000. Now we've got 13,592 left over, and we can carry. Sorry, I know this is a little choppy, but my screen recorder froze and I didn't want to re-record the whole first part of this video. So I'm going to pick up here and just say that any excess cost for the new item that we were not able to take in year one can be taken in the following year, and presuming that they have enough taxable income to do that. Listed property. What is listed property? Basically, you're looking at passenger vehicles, property that's used for transportation other than cars. So it could be an airplane, boat, or property generally used for entertainment, recreation. So you've got like the party bus or something like that. And there are potentially really advantageous deductions that are available to businesses who purchase vehicles or recreational equipment for business purposes. But there are, of course, limitations to that. One of the most important limitations is that the property must be used more than 50% for business purposes to receive this favorable 179 and bonus depreciation. If you use it for less than 50% business purposes, then you're left to straight line depreciation. And so you're probably saying to yourself at this point, okay, wait, so I open up my little side gig here and I go out and I acquire a Maserati, and I can use that every year to a new Maserati to wipe out my taxable income. And the answer is not quite so fast. So the IRS is somewhat wise to this, and they have set limitations on it to prevent people from doing just that. And so if it's a passenger automobile, it is limited to 18,100 for 2019, and then you see the deductions each year for that vehicle go down, and then once you hit 2022, it's 5,760 until the vehicle is fully depreciated. Now, as with anything, there are loopholes. So a vehicle that has a gross weight above 6,000 pounds is not considered a passenger automobile. Well, this was colloquially known as the Hummer deduction, because back when everybody was purchasing Hummers, and those are substantially heavier, I believe, than 6,000 pounds, they were using this 179 deduction to be able to write off up to $25,000 of the cost of the Hummer that is used more than 50% in trade or business when it was in the year it was placed in service. Now, do you think the IRS or Congress sat back and said, how can we create a loophole for people to be able to buy big gas guzzling SUVs in their trade or business and be able to take a whopping deduction the first year they place that vehicle in service? Of course they didn't. This was really the creative thinking of accountants and other tax professionals that figured out that this 6,000 pounds, if you could find a passenger vehicle of more than 6,000 pounds, this opened up a potential treasure trove of deduction opportunities. And let's talk about an example here. We got March 15th, 2019, Jim purchased a new automobile for $52,300. I don't know what you could buy with that. Maybe we'll say it's a nice SUV. Maybe he got himself a Lexus or something. And he uses it in his sole proprietorship that sells medical devices. It weighs less than 6,000 pounds and he uses it 60% for business purposes. He's going to elect out of bonus depreciation. So, what is he going to be able to take in year one? Well, the first thing we have to do before we do anything is allocate the cost of the vehicle to split it between personal use and business use. So just because he uses it more than 50% in his trade or business does not mean he gets to depreciate the entire cost of it, even the personal use. He is just still limited to the business use of that. And so 60% is used in his trade or business. When we allocate the cost, that gets us to a starting point for depreciation purposes of $31,380. Now, we look at the maker's depreciation versus the maximum luxury automobile allowed, and let's see what we get. So if we were just to use our standard makers table on this, that gets us 6,276 thousand in depreciation in year one. However, we're limited by this luxury automobile deduction allowance, and we also have to reduce that by 60% to account for the only partial business use of this vehicle. So the most that we could deduct on the luxury auto limitation is $6,060. So even though makers would give him a greater deduction, he's capped at the $6,060 because of the luxury vehicle deduction. Now, I know this has been kind of a short video, but before I take a complete left turn into intangibles, I'm going to actually stop this video here and go on to the next one.